Hello, I'm Tom Selby, AJ Bell's Senior Analyst, and welcome to Fundamentals, where I'm going to look at the single most popular exchange-traded fund on the AJ Bell Invest Centre platform right now, namely the iShares Physical Gold ETC. This tracker product is an exchange-traded commodity. It's designed to track or mirror the performance of the underlying assets and deliver that performance minus any running costs. This means the tracker is following the day-to-day price movements of gold bullion. The iShares Physical Gold ETC seeks to do this by physically holding the gold bullion through its custodian, JP Morgan, the investment bank. The gold bullion backs the securities issued and is valued daily at the London afternoon fixed price. The product comes with a charge of 0.25%. The tracker has a net asset value of around £2 billion. It's just over 5 years old and sits at 6 out of 7 on the Morningstar risk ratings, meaning it's potentially a high risk investment where returns could be very high or, as you know, could be very low. Those are the basics, but why exactly are advisors and clients purchasing this product now? Well, one word springs to mind when considering the popularity of gold, or a gold tracking ETC: volatility. Markets have been very up and down recently, and at a time of considerable economic uncertainty. The US Federal Reserve raised interest rates in December, while a number of central banks have moved to cut rates and extend quantitative easing in a bid to boost febrile economic growth. Chuck in a dose of post-Brexit vote fear and you've got a pretty fruity cocktail of macroeconomic and political uncertainties weighing on the markets in 2016. In terms of uncertainty, gold, and in this case a gold bullion tracking product, is often viewed as a safe haven for nervous investors. Gold surged higher between 2008 and 2011, for example, as the world was in the grip of the financial crisis. Gold's particularly difficult to source and produce, meaning supply can grow slowly. Contrast this to paper money, which banks can and have created through extensive quantitative easing programs. Gold might therefore be viewed by advisors and their clients as a protective shield against central banks being overly zealous in their efforts to hit their 2% inflation targets. Finally, some central banks have moved to introduce negative interest rates, meaning you have to pay them for the privilege of storing your money with the bank. Advisors and clients may therefore look at gold as a potential alternative to cash in these strange circumstances. So how has the iShares Physical Gold ETC fared? Well, given its 6 out of 7 risk rating, it's no surprise to see its performance has swung around a lot, mirroring moves in the underlying metal. However, the ETC has outperformed others in its category since mid-2013, delivering stonking returns of 42% in the year to date. Such returns obviously come with high risks, but those who backed gold at the beginning of the year have been richly rewarded. This is not to say future strong returns are guaranteed, and many advisors and clients may distrust gold for 3 specific reasons. First, gold has limited industrial use. You can't build or manufacture products with it. It generates no yield or cash and therefore has no intrinsic value at all. Second, it isn't really a cheap alternative to cash. While negative interest rates mean you might be paying to store your cash with a bank, gold tracking products also charge a fee. In the case of the iShares ETC, we're looking at 0.25%. And finally, as I suggested earlier, gold tends to perform most heroically when everything else is suffering. So if the markets decide the central bank stimuli are going to get the economy going again, gold returns may well hit the skids. That's it for this week's Fundamentals. Thank you very much for watching, and I look forward to seeing you again next time.